Hello everybody, this is Jason Wink, and today is Tuesday, August 30. It's about quarter to 1 p.m. Eastern Time. And thanks for checking out my video update on my blog. Today I just wanted to talk about a couple things. One, just a general update on kind of where we're at, and then two, just some nerdy statistics that might help people understand the smart decisions that should be made right now. So this is a chart, I've shown it before. I drew this in a few weeks ago, actually, this blue line that you can see right here. And I mentioned that that seemed to have been support for quite a while, or what we call support and resistance. Support is when on the way down, it seems to want to bounce around that level before either breaking further down, or in some cases, it'll come down to that level before shooting back up. And we saw that happen last summer. It came down to that level, hovered around for a while, and then went up. And we can see that recently the market hit that point, and then it has bounced up. So I have pointed out a couple key levels that I was watching for. I think last week I said, hey, it's really imperative that the S&P 500 stay above 1165 or 1170. It was able to do that. Yesterday there was a really nice day in the market, and the S&P actually I think was up over 2% yesterday, so it's around a little above 1200 now. My last video update from last week, I kind of said, hey, this week the key thing to watch is if we can stay above 1200, and if we do that, that may bode very well for the market in the interim, kind of in the, I'd say, the next 3 to 6 months. So we'll continue to watch that this week. As far as my best guess, I mean, the reality is economic data keeps getting worse. It's every bit of news that's come out really in the past month has been bad as it relates to the health of our economy. I released our RPA, which is our Recession Probability Analytics number. That's a number that goes between 1 and 100, and right now it's around 46, which we want that number to be low. When it goes above 50, that's kind of a big warning sign for us. So it's really at this fragile state. So the economy where it's at and the market trending where it's at, investors need to be very cautious, and there's a lot of things that we look at statistically to help us gauge what's the best way to be positioned, really what's the smart way to be allocated. And what I wanted to share was that right now, the market's kind of looking, there's a what I'll call a setup that tells us a little bit about where the momentum, where the trend is heading. And there's a saying that you never want to fight the tape or fight the trend. You can see trends sometimes when you look at them visually. Now, I'm more of a numbers guy, but the charts work better for videos. So, trends are like what we see here. A market that was very overbought, that trend died, and when it finally kind of died, you see the market peaked back in 2000, and of course the trend was clearly down, and it stayed down until the market got oversold, which corresponded with its bottom. It then began to change momentum, and we had a very nice rally until it again got overbought. When a market's overbought, it can stay that way for a while, as evidenced by what happened back in the late 90s. But in the case of 2007 and 2008, the trend reversed, started going down, and investors who saw that quickly may have been able to find themselves out of the market somewhere after only realizing maybe the first 10% of what ended up being a 65% decline. Again, the trend reversed here, and we can see that the market has corresponded with a nice rally up. The reason I bring that up is the trend again is sitting at a point where if I was to draw a line in here, you'd see the line would be kind of along this zone, so like this, and that trend appears that it could be breaking. It may just be pausing and going back up, but it also looks like it could be a reversal of sorts, and we'll only know that by what happens really over the next month or two. That's why it's kind of too early to make a big drastic change to a portfolio. But another sign of sort of the setup, if you will, we can see down here, this is an area of this chart I've shown everyone before. We call it moving average convergence and divergence. And it's just kind of showing if the shorter term momentum or the trend in the market is getting stronger or weaker than the longer term trend. And we can see that this over the time has also, if I just scroll up a bit so you can see what's happened price-wise, that when the black line tends to dip in a major way below the red line, again, it signaled a longer term drop. We've only seen that happen actually 3 times in the last 20 years. So in those 3 times, I thought I'd share some statistics, some numbers as far as what happened. So 2 of the 3 are pretty easy to see. You can see them right here, one big drop and another big drop. In other words, 2 out of the 3 times the market, when that trend is reversed, has resulted in a 50% or greater decline for stocks. The only other time that it happened ended up being just a short-term blip. That happened right here in the late 90s and sort of the fall of 1998. And when that happened, the market ended up, you can see here, had a quick hard sell-off. It was able to reverse very quickly and go back into an uptrend. So, and by the way, that resulted in a 40% gain. So if we were to measure, for example, what happened the 12 months after a big reversal to the downside, well, 1 out of the 3 times, 12 months later, the market was 40% higher. 2 out of the 3 times, the market resulted in 50% or larger losses. Now, having 3 units of data is a very small sample, but I just want to kind of give people an idea. Since this has only happened 3 times in the last 20 years, we have to be very careful, kind of what type of decisions we make right now. We can't be hasty and just assume that everything's going to pots and then sell everything and get all just in cash. But at the same time, we have to be ready to do that if it starts to look like it makes sense. And the way we can do that is just using some very simple math. So if I just expound on my math here, what I said before was that 3 times this has happened, 2 times 50% or greater losses, 1 time a 40% gain. Now, one thing that's really cool to note is that this time here, where it, again, looked like the trend was reversing, you can see it on virtually every one of these little indicators here. You can see, again, trend reversing. There was a sell-off of sorts. It looked like things could go ugly. Let's just say for a minute that someone did decide to sell their stocks at that time. Well, what we would have learned is that within just a few months, the market would have recovered from that loss. So again, by early 1999, and they could have positioned themselves back into the market. And if they would have done that, they would have actually missed out on about a 15% increase, from the low to the point where the trend had reversed back to being a positive trend. So instead of getting the 40% increase, they would have only realized about 25% of the increase. The other 2 times, had they taken action and sold out of their equity positions, they would have been able to avoid roughly a 50% decline. So they would have been able to see a pretty large amount of the loss eliminated, missed out on just a little bit of the upside, but the net from the point of sale to the point of buying back into stocks would have been roughly a 50% decline completely avoided. So instead of having an average, which ends up being, really average loss of those 3 time periods is 20%, 2 50% declines and 1 40% gain. They could have had an average of an 8.3% gain. So the cost of the decisions we make right now, I think, are really twofold. One is, if this trend that we see happening right now, if it ends up fully reversing and we see that and we take some action, I think the downside to that decision, so the cost could be perhaps things do end up reversing. We miss a little bit of the market's upside. But we also could avoid a major amount of market downside. And in a nutshell, the math favors the investor who is cautious at this time, is conservative at this time, and perhaps they do miss out on a little bit of the upside, because if the trend ends up fully, again, going back to positive, people will be able to get back in. They may have just missed, again, 10, 15, some odd percent like that of the market's upside. And what they gain is potentially the ability to miss out on a major market decline. So the lesson for today is that we're setting up right now at one of these really critical points. That's why I'm posting so many videos. You can see that trend is reversing here. Trend is clearly down here in the short run. And then when we look at sort of the averages of the short term and long term, we can see it's almost looking, again, very similar to the way it looked back in 2000 or back in 2008. If this starts to go through, which won't happen, by the way, for at least another month, perhaps even 2, I think investors would be very wise to take some equity off the table. So whatever their stock positions are, to reduce those significantly. Obviously, our clients will be doing that automatically for them. In the short run, though, we have to see how this plays out. And what happens is when we're in a sort of critical juncture like we are right now, the smart thing to do is to actually be balanced and conservative and then wait to make either a decision to get back more invested or to get completely or in a large way out of the market. So that's really what we're doing right now. I just wanted to give everybody a heads up as kind of to what we're seeing in that front. One other update for today. I did mention this last week or a couple weeks ago that I thought anybody who's getting too excited about gold, they may want to rethink that. Of course, gold has come down significantly from its highs. You can see still that it's quite overbought. I think there's still potentially more downside to gold in the short run before it does resume an upward trend. And the same was true on long-term government bonds. Those had been doing very well. We can see that they had this huge rally when the market sold off, but just like gold, they kind of topped out and have since been coming down a bit. So we have to be very cautious there. At the end of the day, what this means is that even in a balanced portfolio, investors should actually hold some cash right now. It's always a frustrating asset to hold, especially when interest rates are as low as they are. But the one thing we do know about cash is that from a price standpoint, it won't hurt you to the downside. It only hurts you relative to inflation, which is still painful, but it's certainly less painful than seeing a 10 or 15% drop in someone's portfolio. So that's the update for today. I'll be back by the end of the week, I'm sure, for just another update to let everybody know, how some of these different indicators and some of the different trends are developing. In the very, very short term, in other words, for this week, I would be shocked if the market really fell much this week. I think it's possible because we do have just another day left in the month, and there may be people out there wanting to sell so they look smarter than they really are, as though they were out the entire month, something like that. But the largest losses for the months have been erased in the last 2 weeks. So what was once a 20% decline from peak to trough is now only about maybe a 9% decline. It's about half of the losses have been wiped out with a little bit of a bounce. And I'm not sure, again, what will happen next month. It does start in just a couple days. But it wouldn't surprise me if September is, a reasonable month. In other words, there might be some volatility, but I don't know if it's going to be a 10% increase or decline. October is traditionally a very poor month. A lot of the largest drops that we've seen in the last 20 years have happened in Octobers. The last two really major bear markets got really nasty in October, both in 2008 as well as in 2000. So we'll obviously be very cautious for that. And I think unless the economic data is significantly better than the direction it's going right now, investors will probably around that time, sort of the fourth quarter of this year, that might be the time to start looking at being defensive. Again, a lot could happen between now and then, so I'll certainly keep everyone updated. But that's what I see happening as I speak today on August 30. So I'll be back in touch soon. Hope everybody has a great week. And if you have any comments or anything that you'd like to share about this video, questions, things like that, there's always a spot at the bottom of the blog posts that you can simply type in your name. If you want to remain anonymous, just use the name anonymous and then drop your comment or question in there, and I'll make sure I reply back so everybody can get the benefit from that. Thanks again, and again, have a wonderful week.